You're not going to believe this. Builders are cutting deals so deep, even Warren Buffett is jumping back in. And here's the best part about it. For the first time, it's not just Wall Street getting in on the goods. It's the mom and pops. It's the regular folks like you and I. There are some major trends that are shaking up the U.S. housing that we need to talk about. First, you may have heard about this a little bit. Big builders are unloading homes at steep discounts, offering special financing to anyone who can help them clear their shelves. And we're not just talking about the big guys, we're talking about all builders across the board. Second, Warren Buffett's back in the home builder game after stepping out just a year ago. Let's talk about why that matters and what it means for you. So, what's going on with the builders? Let's first of all start with Invitation Homes. They're one of the biggest institutional rental owners in the country. Tens of thousands of homes under management across the U.S. They just told analysts they're getting pretty significant discounts when buying directly from the builders, which tells you one thing: builders are feeling that pain. Take advantage of it if you're a buyer. Inventory is climbing, homes are sitting, sale pipelines are stalling, and in real estate, time kills deals. A home sitting unsold on a builder's balance sheet is a liability. It's not an asset. It racks up holding costs, insurance, carrying costs, taxes, all while the builder's capital is frozen or at least partially frozen. So what do? They go where the cash is. Historically, that meant institutional capital. Blackstone, Invitation Homes, AMH. These groups would bulk buy hundreds of units, sometimes entire subdivisions, with cash or super fast financing. But even those institutional buyers are tightening up. AMH confirmed they're seeing deals too, but most of these homes don't meet their buy box. They don't meet their return threshold anymore at all. Why? Because rent growth has slowed, interest rates are higher, and return on equity models are much more conservative. That should tell you something. Even the pros are passing on a lot of these homes. But here's where it gets a little interesting for us. These incentives aren't just for staying at the top anymore. They ripple down, making it all the way to you small-time buyers. And I say small-time, I mean us individual mom and pop type investors, you and me. We're talking entry-level investors, family buying their second home or first rental property, retirees looking for cash flow properties, because what builders care about now is velocity, turning dirt into dollars fast. They need to keep moving. They're willing to take a haircut today and avoid a full shave later. They're trying to keep subcontractors working, lenders happy, and their pipeline moving. That means they're looking at every buyer profile as a potential outlet, not just the traditional first-time home buyer. But also, the savvy investor and even the accidental landlord are options nowadays. Enter Lennar. They've built an online portal called the Investor Marketplace, and it is an absolute state-of-the-art, game-changing piece of software. You can now log on, browse active inventory, run the numbers on projected rents, adjust assumptions for down payments, appreciation, rent growth, all of it. It's like Zillow meets a cash flow calculator with a financing tab built right in. They're even offering below market interest rates. The 7/6 ARM at 4.99 is no joke. That's a great interest rate. That's well below current market rates, and it's not just about the rates, it's about transparency. For the first time, you can see estimated gross yields, cash on cash returns, expense assumptions, the same numbers big firms use to get behind closed doors and figure out if it's going to make sense. Think about this. You can now get new construction, builder paid closing costs, and a rate that resets in 7 years, with enough breathing room to refinance or sell it before it adjusts. This is the stuff that used to only be reserved for private equity funds. Now it's going to teachers, to cops, to small business owners, everybody across the country. The question is, will you be ready to move when the window opens? And this window, I guarantee, it is not going to stay open forever. Builders are constantly recalibrating. The moment demand starts climbing, they will pull back the incentives. So it's all about timing and being ready. Having your pre-approval locked in, your cash lined up, your market research done. Now, I want to explain why builders are doing this, because it's more strategic than it seems. It's not just simply about getting it off their books. When a builder slows down production, the entire supply chain slows with it. That means subcontractors lose work, supply orders get delayed, permitting gets bottlenecked. And when the market picks back up, restarting that engine takes months. And guess what? Momentum matters. Momentum keeps trades on site, materials moving, and lenders engaged. Momentum is what keeps pricing power from collapsing. So now, instead of protecting margins, builders are protecting velocity. They'd rather take a cut of 5 or 10% of a home's list price today rather than a 50% slowdown in production tomorrow. Stuart Miller, Lennar CEO, said it best: keeping sales volume constant is more important than trying to squeeze out every dollar of profit because the machine is too big to stop. Now let's talk about how these incentives actually show up. Incentives used to be little bonuses, appliance packages, 5,000 closing credits, maybe a temporary buy down. Now you're seeing $30,000 off purchase price, interest rate buy downs, longer locks, below market rate mortgage products, builder credits towards title, escrow, and even landscaping. It's wild out there. And it's not just high-end homes. Some of the most aggressive deals are happening in the $350,000 to $500,000 range. The sweet spot for first-time investors and first-time buyers and those move-up buyers. These are neighborhoods with parks, good schools, and easy highway access. Homes that tenants want to live in. Homes that families want to stay in. According to CRE Daily, investors make up 30% of all single-family home purchase. That's the highest since before the Great Recession. But here's what's wild. Only 5% of those investors are big institution. The rest, those small investors, the mom and pops, the regular folks. Folks buying maybe 1 or 2 homes, fixing up just enough to be rent ready, putting them on the market for $2,000 or $2,200 a month. And because traditional buyers are sidelined by rates, these investors stepped in to fill the void. It's full-blown shift in market behavior. And here's the kicker. Builders are encouraging it. They'd rather sell to 5 small-time investors than wait on one big institutional buyer who may never call back. Let me bring it home with an example. Imagine you're shopping a $450,000 new construction property. The builder knocks off $30,000, drops the price to $420,000. They offer you a 7/6 arm at $499 with 20% down. Your monthly P&I might fall around $1,800 range. Now plug in $2,200 in rental income. You've got a positive cash flow from day one, before depreciation or tax benefits. And this is new construction, so there's minimal repairs, low maintenance, no surprises. The only variable is really your exit plan. You've got 7 years on the low ARM rate, plenty of time to refi, plenty of time to sell, or convert it to some sort of fixed mortgage rate, which again would be a refi. If you're a buyer who's been priced out for years, this might be your shot. Now let's shift gears to the Oracle of Omaha, Warren Buffett. In 2023, Berkshire bought just shy of 6 million shares of D.R. Horton. They also picked up shares of Lennar and NVR. Pretty significant moves, pretty significant headlines at the time. Then in 2024, they sold most of D.R. Horton shares. The market absolutely freaked out. Some said Buffett made a rare mistake. Others said he was just taking advantage of the opportunity. Fast forward to 2025, and Berkshire Hathaway is back in, and they're back in deep. They added another 1.5 million shares of D.R. Horton. They doubled down on Lennar with over $800 million in purchases, and they did it quietly. No press conferences, no interviews, just filings. Buffett is usually a buy and hold guy, but this time it looks like he's trading in waves, and maybe that's a real signal. This isn't about one perfect moment, it's about a window. One where prices are soft, margins are compressed, and smart capital is slowly loading up. Buffett also owns Clayton Homes, the largest U.S. manufactured housing builder in the country. And Home Services of America, one of the biggest real estate and mortgage companies in the nation. He's not guessing. He's betting long on housing. Because even with all the volatility, the rates, the inflation, the supply chain, the U.S. still has a housing shortage. The fundamentals haven't changed. We're short millions of homes. Millennials are hitting peak buying age. Now, new household formation is still strong, and builders can't fix that overnight. So even if there's pain in the short term, discounts, inventory bloat, margin compression, the long view still looks solid. But the opportunity doesn't go to those who wait for the perfect condition. It goes to those who prepare. So what should you do? Here's my advice. Target markets with high inventory. Look at the Sun Belt. Look where new builds are sitting. Days on market, price cuts, active listing. They all tell a story. Study the incentives, not just the sticker price. Look at closing costs, rate buydowns, long-term costs of funds. Understand your financing. If it's an ARM, know when it adjusts and how high it could go from there. And if it's fixed, know your break-even timeline. Play defense. Run conservative cash flow models. Assume rents will stay flat. Don't count on appreciation to bail you out. You need someone who understands the difference between a shiny listing and a good deal. Someone who can walk you through the rate structure, the builder incentives, and how to navigate closing timelines. That's where I come in. My team and I live in this stuff. We know what lenders are offering, we know what builders are moving, and how to get creative without getting risky. Bottom line, this isn't a time to chase hype. It's a time to move with clarity. Builders are cutting real deals. Buffett is reloading, and the people who win are those who show up and show up ready. Talk to your advisor, and if the deal makes sense, let's go to work, and that's guaranteed.